Hi, thank you so much for watching. Today I'm going to show you one of the greatest financial tools that's ever been created. Now, I call this the greatest tool because it has a lot of benefits and features that will protect your assets in retirement and help you to live better and more financially free. For example, one of the features is that it protects you against market volatilities, such as a market crash, a stock market crash, or a housing bubble. It has the ability to help you to grow your unused assets consistently by about 4 to 7% historically. It allows you to access large amounts of cash without being penalized for taxes. And finally, depending on your situation, it could save you thousands of dollars every year in debt payments. Now, it might surprise you that I'm talking about a reverse mortgage, but not the reverse mortgage you've heard about. Today, I'm going to introduce you to the new version of the reverse mortgage after it's gone through the many changes it has over the recent years. My name is Trevor Carlson. I'm the president of Heritage Reverse Mortgage, and I'm a reverse mortgage specialist. I love reverse mortgages. I've seen them change the lives of so many of my clients. And it's always fun to me that when I present this information to people, they're always surprised about what they didn't know about what's changed with reverse mortgages in recent years. I hope your experience is similar. I hope that you learn a lot from what I'm about to show you, and I hope you have a lot of questions to ask at the end. One thing that I ask is that as we go through this information, please keep an open mind. You may decide today that a reverse mortgage still isn't the right thing for you, but I can promise that you have friends or family or neighbors. You have somebody in your life who is looking for options to live better in retirement, and a reverse mortgage might be the solution they're looking for. And so please learn what you can, and when you're ready, call me with any questions you have, and we'll go through your options and scenarios as well. If you've heard anything about reverse mortgages, I imagine you've heard a lot of the myths and the negative stories that exist about them. Now, fortunately, the changes that have happened over the past few years have been designed specifically to address a lot of these issues. But let's talk about why all these negativities exist, so you can understand what's changed and why it was changed. Now, the original reverse mortgage, as far as we know, was done sometime in the 1960s. It wasn't until 1988 that President Reagan signed the reverse mortgage bill into law. And when he did this, it gave authority to HUD and FHA to manage this program. Now, the original reverse mortgage was designed for a very small segment of people. Figuratively speaking, it was designed for somebody who was a flat tire away from losing everything. For people in this situation, reverse mortgage was a blessing. They owned their home, but they had no income. And so they were able to use the equity in their home to receive an income monthly to live better for the rest of their lives. Likewise, they got to keep their home until they passed away, and when they passed away, the home would pay off the debt or the money that they received over the course of their life. The problem is that through the 90s and the early 2000s, lenders and banks were trying to sell the reverse mortgage to all the wrong people. And seniors, too many seniors, were getting a reverse mortgage without fully understanding how it worked for them. The end result is that we've seen a lot of situations that have ended very badly. It's because of these issues that FHA became so aggressive at fixing the reverse mortgage. The government understands that people need options to live better in retirement. And so over the next 10 or 20 or 30 years, this product is going to continue to be a great option for more and more seniors who need the ability to live financially sound. You may have noticed that we hear a lot more about reverse mortgages nowadays. And the reason for this is because demand is growing. I think there are two reasons why demand is growing so quickly. The first is out of necessity. A lot of people are retiring nowadays without the ability to last long term on their limited retirement income. The second reason, however, is about strategy. The new reverse mortgage is more about helping people live strategically better in retirement. It's interesting that the majority of my clients that are doing reverse mortgages today do them because of the strategy of living better long term. And so let's dive into these two reasons a little bit more, because in my opinion, I can say with confidence that over the next 10, 20, or 30 years, a reverse mortgage is going to become as common as a 401k, an annuity, or a pension. When my generation retires in 30 years, this will be the mortgage that we use. Let's talk first about necessity. According to the Social Security Administration, 36% of retired Americans rely on Social Security as their only source of income. When we talk about primary sources of income, 48% of retired couples rely on Social Security as their primary source of income. And single retirees, that number jumps to 71%. And so roughly about 60% of Americans are relying on Social Security for their primary source of income. Now, the problem with this is that the average check from Social Security in 2016 was only $1,360. That means all these people are living on a fixed monthly income of less than $2,600 a month. Now, $2,600 may have worked in the 1980s. It doesn't really work today, and it definitely isn't going to work 20 years from now. And so for a lot of people, a reverse mortgage is the best option to be able to retire comfortably and still own their home. The second reason why reverse mortgages are becoming so common is because of strategy, as I mentioned. The graph that you're seeing now represents life expectancy in America from 1900 to about 2010. Interesting to note that in 1900, the life expectancy of the average American was only 47. We topped out somewhere around 81 in the past few years. But look at this graph over the long term. In 1935, when Social Security was implemented by the government, life expectancy was only 59. And so if somebody lived to qualify to receive Social Security benefits, they were already 3 years over their life expectancy. The politicians of the 1930s didn't expect people to live that long after retirement. Retirement was meant to last a few years, not a few decades. Now imagine what's going to happen to life expectancy in this country over the next few decades. What if we cure cancer? What if we cure diabetes or Alzheimer's or any number of other diseases that are cutting life short for Americans? There's a very real scenario where my children or my grandchildren will live well beyond 100. But how is that going to work if we continue to retire in our 60s? Now, as I mentioned, the strategy portion of the reverse mortgage is designed to help people to extend the assets that they already have. I read an article once that said that most financial planners expect their clients to live until age 85. Now, if you live beyond 85, you may be in trouble. But imagine that you could take a reverse mortgage to supplement the current assets you have now and extend them another 10, 15, or 20 years. And that's what a lot of my clients are doing. So how does a reverse mortgage work? The easiest way for me to explain the mechanics of a reverse mortgage is to compare it with a conventional mortgage, the mortgage you've had your whole life. Now with a conventional mortgage, you borrow money from the bank. Over the course of the next 15 to 30 years, you're agreeing to make payments to the bank to pay that mortgage off. And so your monthly payment includes a little bit for your taxes and insurance. It includes a little bit to pay down your principal, but really what you're paying every month is the interest that's accruing on the balance of your mortgage. A reverse mortgage really is about the same. The only difference with a reverse mortgage is that there is no required monthly payment. And so typically with a reverse mortgage, you'll pay your taxes and insurance on your own. The principal, or the money you borrow from the bank, is repaid either when you pass away or you sell the home down the road. And so the only real difference is the monthly interest. Interest is still accruing monthly, but because you don't make a payment, the interest is added to the balance of your mortgage over time. And so the end result is that with a conventional mortgage, you make a payment and your balance will slowly trickle down until you pay it off in 15 or 30 years. With a reverse mortgage, you don't make a payment, and so your balance will slowly trickle up over time, again until you pass away or sell the home. Now I have to emphasize here that even though you don't have a monthly mortgage payment, you are still responsible for the basic property expenses, such as the property taxes, the homeowner's insurance, the HOA, and basic maintenance on the home. I would also like to add here that even though you don't have to make a payment, you can make a payment. And I'll explain in a moment why a lot of my clients are doing that. But suffice it to say that when you make a payment on a reverse mortgage, it does the exact same thing as when you make a payment on a conventional mortgage. So a lot of my clients will ask, well, what happens if our home goes upside down? With the old reverse mortgage program, this was pretty common. But fortunately, with the changes that were made, it's very much less likely that your home will go upside down. But if we do go through another housing bubble, and that is the case, when you pass away, if there is a loss on your home, the mortgage insurance that FHA is providing for this mortgage is going to protect your estate. That means that if there is a $50,000 loss, the bank cannot go back on your children or your estate to demand the payment for that loss. The mortgage insurance from FHA will cover those losses and your family is protected. So who qualifies for a reverse mortgage? Like any other mortgage, there are a lot of requirements that we deal with, but the three primary requirements we have are: number one, at least one homeowner must be 62 or older. Now this is a big change from the old reverse mortgage program. In the old days, anyone that was on the mortgage had to be 62 or older. But you can see how this caused a lot of problems, because if he was 62 and she was only 61 when they did the mortgage, he was the only one on the mortgage. Fast forward 20 or 25 years, if he was to pass away first, this could leave her in a very difficult situation. Having used most of their equity by that point, she may not be able to refinance or sell the home and have enough money to buy a new home. And so with the changes that have been made in recent years, the requirement was changed to be only one homeowner has to be 62 or older. If the couple is married, then the spouse must be on the loan. Whether the spouse is 18 or 58, that spouse must be on the loan. And the nice thing about this is this protects both homeowners for the rest of their lives. As long as one of them is living in this home for the rest of their lives, they're going to be protected by the reverse mortgage program. The second requirement is that the home must be your primary residence. This simply means that you live in this home for at least 6 months and 1 day out of the year. What you do with the rest of the year is, of course, your business. And so if you have another home in a more suitable climate, or if you like to do a lot of traveling, that's all great. As long as you say that this is my home base, this is where I get my mail, then we're fine. We meet that requirement. The third requirement we have is the equity reserve. Now, I explained earlier that with the reverse mortgage, the interest is being added to your loan. And so over time, your balance is going to grow. Now, we want to protect your home from going upside down. In the old days, this wasn't the case. Most reverse mortgages were designed to use all of the equity left in the home. And so if you lived to be 80, 85, or 90, there was a high likelihood that you probably didn't have any equity left over with that old reverse mortgage version. The new reverse mortgage version wants to protect that equity. We want to make sure that your home doesn't go upside down, or at least we protect it from going upside down for as long as possible. And so with the new reverse mortgage program, we're setting aside enough equity up front, and we're charging a lower interest rate so that your home's equity will go further. Now, I must disclose here that the equity in your home is dependent upon the market. And so it doesn't matter if you have a conventional mortgage or a reverse mortgage. If the housing values fluctuate, your equity is going to fluctuate with it. But by and large, we're trying to extend your home's equity for as long as possible to secure your future and the future of your home's value. Let's use an example so you can see what I'm talking about with this equity reserve. Imagine we have a homeowner named Bob. Bob owns a $400,000 home, and at Bob's age, we need roughly about 50% of his equity as an equity reserve. And so we take his $400,000 home. We take $200,000 of that equity and we just leave it alone. He's not forfeiting this money, he's not giving it away to the bank. We're just saying we're not going to touch this. The other $200,000 is what Bob can use. Now, this is used to either pay off his existing mortgage, it's used to consolidate debts, to vacation, or if he doesn't need that money right now, we just leave it in a line of credit and he can access it further into the future. A primary question that a lot of my clients ask is what happens when we pass away? And the easiest way for me to explain this again is to refer back to a conventional mortgage. If you had a conventional mortgage today and you passed away, your estate has 3 options. Number 1, they can refinance the home. They pay off your mortgage using their own mortgage and they keep that home. Number 2, they sell the home, they pay off your mortgage and they keep any equity that's left over. Or number 3, they can walk away. If the estate walks away, the bank is going to foreclose on the home. The bank will sell the home, and if there is any money left over, that money still goes to the estate. Now, a reverse mortgage is exactly the same. If you have a reverse mortgage, when you pass away, your children have the option to refinance to keep the home. They sell the home to keep any remaining equity, or they walk away. Now, in the old days, the reverse mortgages typically used so much of the home's equity, if not all of the equity, that when the homeowner passed away, there was nothing left over for the family to inherit. With the new reverse mortgage, again, we're trying to prevent this. We want to make sure that no matter how long you live, we're trying to keep as much equity in this home as possible. But let's imagine that you live a very long time, and just before you pass away, the housing industry goes through a major correction. And so let's imagine your home is upside down when you pass away. In that situation, there is a nice feature with the reverse mortgage that allows the estate to purchase it at 95% of its appraised value. And so referring again to our example, Bob. Now, if Bob owns a home, let's say Bob does a reverse mortgage today. He lives another 20 years. When he passes away, his mortgage balance is $350,000, but the home is only worth $300,000. In this situation, if the children want to keep the home, appraisals will be done, and the children will have the option to buy the home at $285,000. And so they get a 5% discount on the actual value of the home. And because this loan is insured by FHA, those losses are covered by the mortgage insurance fund. And so the family gets to keep the home at a lower price. Let's talk about the two basic ways that you can structure your reverse mortgage. The first is what we call the traditional fixed rate option, and this is just what it sounds like. Your interest rate is fixed for the life of the loan. The idea is that you're borrowing money from the bank to buy or refinance a home, and you never have to think about it again. It's kind of a set it and forget it model, where you don't have a monthly mortgage payment and your interest rate is fixed for life. The downside to this option is you don't get any future draws. Now that leads me to the second option, which is what we call the growth line of credit. And interestingly enough, the majority of people use this option because it has a lot more features and flexibility. And so, just like the fixed rate option, the line of credit is just what it sounds like. It's a line of credit. It gives you access to large amounts of money that you can take when you need it. Now the great thing is you're only charged interest once you actually borrow the money. Likewise, another benefit is this money is always non-taxable. And so whether you take a few $100s or a few $1,000s or many $1,000s, the government's not going to tax you on the money you draw from your line of credit. Now, one of the best features of this growth line of credit is that the equity you have not used is going to grow at a rate that's equal to your interest rate plus your mortgage insurance rate. And so let's go back to our example of Bob to kind of illustrate how this looks. And so remember, Bob has a $400,000 home. Let's imagine that Bob's home is paid off and he owns it free and clear. At Bob's age, we're going to take 50% of his equity and we're going to leave it alone, put it into his equity reserve. The other 50%, or the other $200,000, is what Bob can use as he wishes. Now, let's imagine Bob doesn't need this money today. He's planning for the future, and so this $200,000 is going to sit there for the first year. So if Bob does not use his line of credit, he's going to grow from $200,000 to $210,000 after the first year, then up to $221,000 after the second year. If Bob goes 5 years without using any of that money, he will now have over $255,000 available for him to draw at any time. Where else can you get a product like this, where you have the backing of the government? You're protected against market downturns. You have the ability to draw large amounts of funds easily and not be taxed for them. That's why we see so many people using the growth line of credit as the option that they choose when they do a reverse mortgage. At this point, I'm assuming you have a lot of questions, and if so, that's great. You might also be saying, this all sounds too good to be true, and trust me, I hear that a lot. The next few minutes, I'm going to focus on giving you real scenarios of clients I've worked with in the past few years. Now, of course, I've changed their identities, but these situations are absolutely real. These are real situations where people are benefiting by doing a reverse mortgage. Now, this first person is widow Sophia. Sophia came to me about 1.5 years ago, just after her husband had passed away. Not only did she lose the love of her life, but she was forced to choose between keeping her own Social Security income or taking his Social Security income. Of course, she went with his, but that leaves her with a fixed monthly income of just $1,500. She also had a mortgage payment of $1,100, a car payment of $250, credit cards and insurances. So by the time Sophia went to the store to buy groceries, she was already out of money. Doing a reverse mortgage for widow Sophia was an absolute life changer. We were able to pay off her mortgage, consolidate all of her other debts, and get her a line of credit for about $40,000 that she can use in the future as she needs it. And so you can see that in this situation, it still works. This is why reverse mortgages were created in the beginning. This is actually why I started doing reverse mortgages exclusively. I was seeing that in this situation, I was helping people dramatically improve their lives in a meaningful way and live better for the rest of their lives on the assets that they already have. We'll call this next couple the Robinsons. Now, the Robinsons are a very common demographic where I live. The idea is that they're either downsizing or they're relocating from another area. They sell their previous home and they walk away with $250,000 in cash. Now, their primary goal is that they want to avoid the same situation that we just talked about with widow Sophia. So they take the $250,000 they receive from their old home, and they can either buy a new home for $250,000 and they pay cash for it. Now they own this home and they don't have any payments, but they also don't have any reserves either. If they supplement a reverse mortgage, they could buy that exact same $250,000 home, but at their age, they only have to put 50% down. And so they keep $125,000 in the bank, they own this home with no payments for the rest of their lives, and they have a nest egg that they can either travel the world with or they can keep for emergencies or reserves. The third option is that they could take the full $250,000 and use it as their down payment for a $500,000 home. And so they get to buy the house of their dreams. And again, they own this home for the rest of their lives with no mortgage payments, as long as one of them stays in the home. And so with all three of these options, they've accomplished their primary goal of owning a home with no required monthly mortgage payments in case something happens to him and she's left without his income. Now, you can see that by using a reverse mortgage, this couple has greatly improved their situation and their options in buying their new home. This is David. Now, in David's situation, he owns a $680,000 home free and clear. Likewise, David has over $2 million in investments and assets. And so most people would look at David and think, this doesn't make sense. Why would you do a reverse mortgage? You have plenty of money. For David, it's about strategy. David loves to invest. He loves to find homes and flip them. And so let's imagine that David finds a home that he wants to flip. His options are, number one, he could go to his investments and take out enough money to buy this home and flip it. But if he does that, he's probably going to have to take out about an extra 20% just so he can pay the taxes. If David uses his reverse mortgage, he can have up to $320,000 within a few days. He can buy this home, 6 months later he'll flip it, and then he can go back and pay his reverse mortgage back down. He's only taxed on the profits he made on the home he flipped. None of that money he pulled out will be touched by the government. Now, imagine if David uses this strategy for the next 10 years. That line of credit's going to grow at about 4.5% in his situation, and it'll be worth over $500,000. If David does this for the next 25 years, his line of credit will be worth over $1 million. And the nice thing about this is that over the next 25 years, we're likely going to go through at least 2 or 3 recessions. If David's home was only worth $800,000 at that point, it doesn't matter. David could still request a full $1 million and have it deposited into his account within a few days. Now, this is why we're seeing so many people with money do a reverse mortgage. They're not doing it out of necessity. They're doing it because they see it's a better way to utilize the assets that they have to take fuller advantage of life and the opportunities that still present themselves. This is Mrs. Smith. Now, Mrs. Smith is ready to retire. She's been teaching school for 40 years and she's ready to call it quits. She's been very conservative in her career and she's put a lot of money into her 401k. And so she has a great Social Security income, she has a good pension, and she's got a 401k that'll carry her comfortably for the rest of her life. She also owns her home free and clear, which is worth about $250,000. A lot of people would look at this situation again and say, why are you doing a reverse mortgage? You obviously don't need it. For Mrs. Smith, it's about insurance against the unknown. She wants to know that her financial plan is intact and protected for the rest of her life. And so when we set up her reverse mortgage, we take her $250,000 home, which is free and clear. At her age, we can set up a line of credit for $105,000, and it's going to grow at about 5%. If she never uses that for the next 30 years, her available funds will be over $500,000. But let's imagine along the way she needs $50,000, maybe for a surgery, maybe she wants to travel the world, or she wants to do something nice for her children. Now remember, if she takes that money from her 401k, she actually has to take an extra 15 or 20% just to pay her taxes. And that's also going to mess up her income projections for the rest of her life. But if she uses the money in her reverse mortgage, she could take that $50,000, she doesn't pay any taxes on it, and she doesn't have to make a monthly payment. When she passes away, the children are still going to inherit the home. Their only responsibility is to pay off the $50,000 she borrowed, any closing costs that were added to the loan when she did the loan, and any interest that she didn't pay in payments after she borrowed the money. They get a home with all of that equity still intact. Now let's imagine that she never needs this money. She sets the reverse mortgage up today, but she lives the rest of her life and never borrows anything. Then what happens? In that situation, the children inherit the home and it's essentially free and clear. Again, the only thing they have to pay off would be anything that she added to the loan along the way, whether it be closing costs or a few $1,000s that she borrowed along the way. If she doesn't borrow anything, they don't have anything to pay off. This last scenario is Jerry. Now, Jerry's 62, he's young, and he plans on working for at least another 10 years. This is a very common scenario with my clients these days. Now, Jerry is fine making a mortgage payment while he's still working, especially because he likes having that interest deduction on his taxes. And so let's imagine that Jerry has a mortgage today. His interest rate's 4.5%, he's got a balance of about $200,000, and he's fine making his payment for the next 10 years. Jerry's minimum payment is about $1,015 every month. And so over the next 10 years, Jerry's going to pay the bank $122,000 in mortgage payments. But here's what stinks about this. Of Jerry's $122,000, only $40,000 of that was applied to pay down his principal. The other $82,000 was just interest. And so it's gone. Now, let's imagine that just as Jerry's about to retire in 10 years, the market goes through a correction, and he loses just 20% of his home's equity. Overnight, he's going to lose about $80,000 of his home's equity for forces that are outside of his control. All of that money he's paid faithfully for the past 10 years is gone. He can't access any of it. And even if he could access it, the only way he could do so is either by doing a home equity line or refinancing his mortgage. And if he does that, he's going to increase his payment just as he stops working and enters retirement. Now let's compare this option with what Jerry could do with a reverse mortgage. With a reverse mortgage, Jerry has the same $200,000 balance, he has the same interest rate at 4.5%, but the number one benefit for Jerry is that his payments are always voluntary. Now remember that Jerry's planning on working for the next 10 years. He's planning on making that $1,015 payment every month so he can get his interest deductions and pay down his balance. With a reverse mortgage, Jerry is still free to make those payments. And if he makes that same $1,015 payment, he's going to do the exact same thing. After 10 years, he will have paid $122,000 to the bank. He will have reduced his principal balance by $40,000. He will have had an $82,000 deduction on his taxes. And so Jerry's in the exact same position. Now, all of Jerry's payments have been voluntary. And so if there was a month at some point where Jerry wanted to go on a cruise and he didn't want to make a payment, he's free to do so. If he doesn't make a payment, nobody's going to call him, nobody's going to hurt his credit. He simply doesn't make a payment that month. Now, the great thing about this is that with having the reverse mortgage line of credit, every dollar that Jerry's paid into his mortgage has also been added to his line of credit. And so that $122,000 he's been paying over time has grown by about 5%, and now he has over $155,000. And so at the end of 10 years, he can just say, I'm done. I'm not going to make any more payments. He can also go to his bank and say, hey, I want you to start paying me, or I want you to give me all of this money back, and the bank will give it to him. A lot of people will come to me in their 60s and they say, you know what, we've got great income, we've got good health, I don't think we need this right now. Maybe we'll come back in 5 or 10 years. My advice is to really think about your future and think about how this could be one of the best things you did today to help you 10 or 20 years from now. Statistically speaking, if we take the average American couple at age 62, 20 years down the road, he's going to pass away first. She's going to survive him by another 5 or 10 years, but she has to do that without him and without his income. Imagine she could go to her bank and say, hey, things have changed, I can no longer make this payment. And the bank says, okay, that's fine. And she says, on top of that, I actually need you to start paying me every month, or I need you to give me all of this money back. And the bank says, we'll get that right over to you. That's why a reverse mortgage could be one of the best things you do today to protect you 10 or 20 years from now. By setting up your reverse mortgage now and using it strategically, you could be protecting the assets you have, and you could be helping yourself down the road without actually knowing it. This brings me to the end of our presentation. Thank you again for watching. Now, there's one last thing that I'd like you to consider before I let you go. Now, I don't believe a reverse mortgage is right for everybody. In fact, I have a lot of clients where I recommend they not do a reverse mortgage because I can see it's the wrong thing for them. But if you're 62 or older and you qualify for a reverse mortgage, I believe you should know your options and you should know the truth about what the reverse mortgage is today. There are a lot of people that are struggling from month to month in retirement because they don't know about these options. They don't know about the changes that have been made to the reverse mortgage and how it could benefit them dramatically for the rest of their lives. Now, I hope you'll consider what your life should look like in retirement. I hope you'll consider what your legacy should be to your family. I say this with feeling because I've lost both of my parents. And when I remember my parents, I don't think about the money that I received and split 8 ways with my siblings. I think about fishing with my dad. I think about Christmas traditions with my mom. I think about arguing around the kitchen table about politics. Those are the memories that I cherish when I think about my parents. And I hope that the legacy you leave to your family similarly will be based around the time that you're spending with them. If you feel an obligation to leave more of an inheritance to your children, I would recommend you talk to them, because the odds are they're going to tell you to do what's best for you. They want you to live better. They want you to have a better life. You've spent your entire life taking care of them, and they want you to be happy in retirement as well. Now, If you have more questions and when you're ready to look at your options, please call me. You can reach me at 435-359-9000. Or you could visit us at heritagereversemortgage.com to find a lot more information about the reverse mortgage. I'm constantly posting videos and articles about the changes that are happening and how these things could benefit you or somebody you love. Thank you again, and I look forward to speaking with you.